Everyone's talking about AI killing SaaS. And look, AI is real, the threat is real. And we've spent 12 videos unpacking exactly how it reshapes your moat, your pricing, your product. But almost nobody is talking about the 47 billion in distressed software debt that can actually kill your exit, your funding, and your options, whether AI touches your product or not. I'm Jeff Maines, and today we're going to talk about the crisis behind the crisis, the one that Wall Street knows about, the one your investors are quietly sweating over, and the one you need to prepare for right now, because this isn't theoretical, it's already happening. This is video 13 in the Futureproof series, and it's a late edition because as I was finalizing the series, something started breaking in the credit markets that I just couldn't ignore. So here's what's happening. For the last decade, private credit lenders have been the rocket fuel behind software M&A. They wrote checks to private equity firms buying up SaaS companies, billions and billions of dollars. And why do they do that? Because SaaS look like the perfect asset. It's pretty awesome, isn't it? Sticky revenue, high margins, predictable renewals. It was the safest bet in lending. But now, for the first time in a decade, those assumptions are being stress tested and the cracks are starting to show. $47 billion dollars in software debt is now classified as distressed. Covenant breaches are up, markdowns are accelerating, redemptions are rising. And here's the thing, this isn't just a Wall Street problem, it's about to become a your problem. Because when the credit market sees up, it doesn't just affect PE firms and lenders, it affects you too. Your exit options, your funding options, your runway. So today we're going to unpack what's really happening, why it matters, and what you need to do about it. Let's go. Let me set the stage. Private credit is a $3 trillion market. That's trillion with a T. And somewhere between 600 billion and 750 billion of that is tied up in software. And for context, that's more than the entire global venture capital market. How about that? How did we get here? Well, for the last 10 years, private credit lenders have been making massive bets on software. And here's how it worked. A private equity firm wants to buy a SaaS company. Let's say it's a $100 million deal. They put up 40 million in equity, and the rest, they borrow from private credit lenders. The lender writes a $60 million loan. The terms are based on predictable SaaS metrics, ARR, renewal rates, margins, and everybody wins. The PE firm gets the company, the lender gets interest payments, the seller gets liquidity. I mean, this model worked out beautifully for years. Why? Because SaaS revenue was predictable. If a company had 10 million in ARR and a 95% renewal rate, you could model out the cash flows with confidence to pretty much infinity. Lenders loved it. PE firms loved it. Founders, of course, we loved it. But now the assumptions are breaking, and here's what's changing. Fewer seats. Companies are cutting SaaS spend. AI is automating workflows, and customers are consolidating tools. So that 10 million in ARR, it's not growing anymore, and in some cases, it's actually shrinking. A second reason is revenue is stalling. Renewals are still happening, but expansion revenue, the thing that made SaaS so attractive, that's drying up. Net revenue retention is dropping and growth is slowing. I think net revenue retention is one of the most telling signs of a company's future right now. So that's something to pay attention to. Number three is covenant misses. Those loans that we talked about, they come with covenants, rules that the borrower has to follow. Things like maintain at least 20% revenue growth or keep EBITDA margins above 25%. And if you miss those covenants, the lender can demand changes, or worse, they can demand their money back so they can pull those loans. And right now, covenant breaches are spiking. And by the numbers, $47 billion in software debt is now considered distress. That means the borrower is struggling to meet their obligations. So markdowns are accelerating. Lenders are writing down the value of their loans because they don't believe they'll get paid back in full. And redemptions are rising. Investors in these credit funds are pulling their money out, which means lenders have less capital to deploy. It's a vicious cycle, and really it's just getting started. So let me show you how a Wall Street problem becomes a founder's problem. So here's the sequence. We'll start up here and we'll just say, seats. So we have, fewer number of seats. And what happens then is revenue stalls. Companies cut SaaS spend. And so we'll say rev stalls. Not selling as much. Your ARR growth slows, maybe even goes negative. Still a good company, still profitable, but the growth story is just softer. And so in revenue stalls, talked about this, there are covenant misses. So say covenant miss. The PE firm that owns you or the debt heavy company you're competing with. And so there's some companies out there, some competitors that are going to have some challenges here. They start missing their covenants. They promise 20% growth or delivering 5, and the lender is unhappy. And those covenant misses lead to markdowns. We'll just say markdown. That lender marks down the value of the loan, and that $60 million loan, they now value it at $50 million or $40 million. And this triggers a problem for the lender. Their fund performance looks bad. Their investors get nervous. So what do their investors do? They're like, I think I'm going to take my money out of this fund because it is underperforming. And so that's what we call redemptions. Like, we're going to take my money out. And now the lender has less capital to lend. So they tighten their standards. They get pickier. They lend less. And so what does that mean? Well, that means that credit tightens. So we're just going to say credit, available credit, is less. So fewer lenders, fewer loans, higher interest rates, tighter terms, and this affects everyone in the market, not just distressed companies, everyone, even the ones that are doing great. And so as credit tightens, what happens? Well, there's less credit available. I just told you how all of those exits happen where they put up so much equity and then they take debt. So then that means that there are fewer exits. And we'll do this different. Just say exits are less. Private equity firms can't borrow as easily, so they do fewer deals, and that means fewer acquisitions, fewer exits, fewer liquidity events for founders. And fewer exits, what does that mean? Well, that means that there is less venture debt. So again, we'll say less venture debt. And venture debt lenders look at the market and they're like, hey, if there are fewer exits, how are these companies ever going to pay us back? So they pull back too. Fewer venture debt deals and tighter terms. And less venture debt deals, what does that do? That's you. Now it's your problem. You're planning to raise venture debt to extend your runway, and maybe that's not available. You're planning a PE exit in 18 months. Well, that timeline just shifted. You're hoping to raise a Series B. The bar just went up. See how it works? It starts with something abstract, covenant breaches, markdowns, and ends with something very concrete, and that is, fewer options. And that's really the big deal here for founders is fewer options. This is the crisis behind the crisis, that AI is reshaping demand, but credit is reshaping supply of capital, supply of exit, supply of options for founders. And if you're not paying attention, you could be caught off guard. The number one thing that kills companies is running out of money, and we don't want that to happen. So what exactly do we do about this? And I'm going to give you 3 scenarios and 3 moves. Scenario number 1, if you're carrying venture debt, if you have any venture debt on your balance sheet, you need to know your terms cold. And this happens so often where a company is acquired, they get a bunch of venture debt, and that goes on the balance sheet, and then the private equity or venture fund takes the dollars back, and then now that company just has debt service. So what to check? What are you promising? What are your covenants? What are those commitments? Is it revenue growth? Is it cash balance? Is it ARR targets? What is your maturity date? When does this debt come due? And do you have enough runway right now to pay it back or refinance? Is refinance even going to be an option? Number three is, what are your options? What happens if you can't pay it back? Can you extend? Can you renegotiate? Or are you at the lender's mercy? Action item here: schedule a call with your lender this week. Don't wait for them to call you. Be proactive. Ask, what do we need to do to stay in good standing? And if you're close to a covenant breach, start the conversation now. Lenders are far more willing to work with you if you're transparent and if you're early. Don't wait until later. Scenario two: if you're planning a PE exit in the next 12 to 24 months, here's kind of where we are today. If you're counting on that private equity exit to give you and your investors liquidity, I would say you need to adjust your timeline. And why is that? Because the credit markets are tightening, PE firms are doing fewer deals, and the deals they are doing are taking longer and coming with lower valuations. So what does this mean? Your exit might take 24 to 36 months instead of 12 to 24. Your valuation may be 20 or 30% lower than you were hoping. You might need to show stronger fundamentals to even get a bid. And for you, the action item is to run your numbers. Can you extend your runway by 12 months? Can you get to profitability sooner? Profitability is not a bad word. This is a good thing that every company should be doing. We forgot about that in SaaS for a long time for some reason. If you can't extend your runway and you need an exit, consider moving your timeline forward. Talk to bankers now. Start the process earlier. Don't wait for the perfect moment, because in 12 months, the window might be even narrower. Maybe it'll be bigger. But I think this is going to be something that's probably another couple of years to work itself out. Especially after all the deals that were done in 21, 22. Due diligence was done with an Etch-a-Sketch and an abacus. Crazy stuff. And so that's got to work itself out of the market now. Scenario three is you need to raise. So it could be equity, it could be debt. And if you're planning to raise capital in the next 6 to 12 months, the bar just went up. And again, why? Because investors and lenders are being more cautious. They're looking at the same doom loop that I just drew. And they're thinking, how do I avoid getting caught in this mess? And they're going to be pickier, more due diligence, tougher terms, lower valuations. So for you, what this means is you're going to need stronger unit economics, you need better retention, and you need a clear path to profitability. You'll need a more compelling story. Why are you the exception to the rule here? You'll need more time. Fundraising cycles are stretching. What used to take 3 months might now take up to 6. So for you, the action item is to start fundraising earlier than you planned. If you were going to start in Q3, start now in Q1 or Q2. Get your metrics in order. Know your CAC payback, your LTV to CAC ratio, your net revenue retention. I think I've said that many times. I think that's one of the best metrics for a business, just from a health perspective, because investors are going to dig deeper than they did just a couple of years ago. No more abacus and Etch-a-Sketch for due diligence. So 3 moves for everyone, no matter which scenario you're in. Here are 3 moves you should make right now. 1 is to extend your runway. Cut cost, negotiate with vendors, delay hiring. Do whatever it takes to add 6 to 12 months of runway. And why do I say that? Because the next 12 months are going to be bumpy. It's just the way that it's going to be. And the founders who survive are the ones who have time to navigate. They're going to be the ones who can afford to make a mistake or two and stay on track. Second is to accelerate profitability. If you're not profitable, can you get there? And can you get there fast or faster? Cut out the nice to haves, focus on the core, and drive efficiency. And why is that? Because profitable companies have options. Unprofitable companies are at the mercy of the capital markets. And that's going to be, I would say, pretty ugly over the next year. Number 3 is to move your timeline. If you're planning an exit, don't wait. Move forward if you can. And if you can't move forward, prepare to wait longer. There's this, the middle ground. Assuming everything will go as planned is probably the most dangerous place to be. Here's the key takeaway. I mean, founders who survive credit crunches aren't the ones with the best product. They're the ones with the most options. Options, to extend runway, to pivot, options to wait, options to move fast. If you're dependent on a single path, a single funding source, a single exit timeline, a single growth assumption, you're vulnerable. So start building optionality now. Talk to your lenders, model out different scenarios, and shore up your balance sheet. Because a credit crunch isn't going away in 90 days, it's going to play out over the next 12 to 24 months. And the founders who see it coming and prepare are the ones who are going to come out the other side stronger. All right, that is the crisis behind the crisis. In the next video, we're going back to kind of regularly scheduled programming, recurring revenue versus recurring relevance. We're going to talk about why high ARR doesn't mean you're safe and how to measure whether you're actually relevant to your customers. Hit subscribe so you don't miss it. And if this video hit home, share it with a founder who needs to hear it, because too many founders are focused on the AI threat and completely ignoring, or maybe just don't know about the credit threat. So don't be one of them. Thanks for watching. Now go build some optionality.